Hi guys, welcome back to Coaching Coins. I'm the host. My name is Ann Nguyen. Today I have a co-host, Tommy.
Hello everyone.
Tommy is our P4 student in Houston, Texas, and I'm his preceptor, but speaking with him, he has a lot of financial sense that I want him to share with you guys. Today we're going to talk about retirement and how to plan and things I wish I have known in my 20s that I now wish I've known earlier. And Tommy, I'll kind of switch the ball over to him and things that he can talk about and how he get into this retirement, even though he is only, in his 20s and still in pharmacy school.
Yeah, so definitely right now you're probably not even thinking about retirement. You're thinking about, I need to go out and get a job. I haven't even started working yet. But at this age, it's actually the perfect time to start thinking about retirement, maybe even earlier than this. And one of the things I suggest is start your retirement saving early. I can't stress that enough. The earlier you start, the better. And so hopefully at this point, you're probably at least working a job, whether it be a pharmacy technician job or just, you're waiting at a restaurant, any job. But definitely when you go to work, you want to save some of that money that you're earning from the job. And probably the only way to successfully save is to have your money auto-deduct into your savings. Many companies offer this to where you can deposit it into a 401k if that's something they have. And it auto-deducts out of your paycheck. And in my opinion, having it auto-deduct, you'll never know the money's gone because it was never yours to begin with in a sense. It never showed up in your bank, basically. And so to speak a little bit further about your 401k, the companies that do offer it, oftentimes you'll see that they'll match your contribution. So for example, the company I work for matches 6%. So if you put 6% in, they'll match it 6%. So in essence, that's basically free money. So you definitely at a minimum want to put that amount in. At the beginning, it might not seem like a lot, but as time goes on, you'll see that as the interest builds up, your money quickly adds up. If you're already contributing into your 401k, I think I suggest is actually increasing the amount you contribute. So like I said, my company matched 6%. The past year I actually increased my contribution to 10%, and it's made a big difference in the amount of money I see in my 401k.
So how did you even get to this point of thinking about retirement, even when you're in pharmacy school and having student loan?
Well, the thing is, when you get out into the workforce, I don't think you want to work for the rest of your life. That's why you need to start saving now. I mean, do you want to work when you're still 80? Not really. You want to be traveling the world, enjoying your life, and you just need that money set aside to be able to do that. And so, yeah, you need to just start saving for your retirement now.
And the time is with compounded interest. And I'm giving just kind of an example. Like if you're in your 20s and invest $300, but if you wait until you're 40, that $300 will not be the same due to inflation, right? Because there's roughly about 3% inflation. And 20 years down the line, you probably need to put in like another 600 or more to really try to get the same amount at the retirement age of 65. So time is we can buy a lot of things. The only thing we cannot buy is time, and for it to build interest on the previous. So being able to think of it like that was very helpful. Honestly, for me, I know about saving because my parents have raised me up to you make sure you save money, and I always do. And I even go to like a financial class in college, like probably my junior year, and then to save. And when I think of saving, I just put in my bank, right? But with your bank, if you think about saving your bank, it's the rate that they give you is abysmal. It's like less than 1%. It's like 0.12%. I mean, whatever it is, it's very little that it's not even worth it. So think about saving. Don't just think about saving in your bank unless you have a goals going towards, I'm gonna buy or do a trip or whatever it is. Like short term, maybe bank that you need your money immediately. Bank would be a good option. But if you're committed for long term financial growth, you want to think something bigger or that will give you a higher return. Again, certificate deposit CDs will give you a higher rate, but they will only give you a higher rate if you leave it there longer than a year or 2 years. If you leave it there 6 months, again, the rate's not great. And we'll talk about in terms of investing your money, like stock market. And I know Tommy does some dabble in that, so I'm going to ask him how he does it. My husband also started getting into the stock market after pharmacy school, because stock market can, again, there's a lot of variances and it fluctuates up and down. But historically, if you look at it, it really shows good return, at least 7 to 8% annually, even with a crash or whatnot. But as a 10-year, 20-year, 30-year down the line, you never want to look at like one dip, right? It's there for long term. And this long term is really 10, 20 years down the line that you have to think about. So how did you get into investing your money in the stock market?
Okay.
What resource you use, who guided you, things like that?
Yeah, well, first off, there was a saying I heard, and it was, a penny saved is still a penny. And I really thought about that. If you're just saving your money, let's say, at home, under your bed, or in your closet, nothing's gonna happen to your money. If you saved $1, when you come back 10 years later, guess what? It's still $1. In fact, it might actually be worth less due to inflation. Mm-hmm. So with that in mind, you have to think about a way to multiply your money, and like Ann mentioned, the stock market is a great way to multiply your money. Historically, you'll see that the stock market, it has its ups and downs, but it usually bounces back, and you'll see, like she said, 7 to 8%, maybe even 10% return annually. Something I started with was an app called Robinhood. They don't charge any transaction fees when you trade on the stock market, so it's a great way to start. You don't need much money. If you want to just start with $100, see how it works. Then maybe you want to increase it to 1,000, 10,000, whatever you have available. Another thing to mention though is with the stock market, if you take higher risk, there's higher rewards, but like I said, it's a higher risk. If you take lower risk, the reward might be less. So something just to consider when you're investing your money.
Mm-hmm. And one thing with the stock market though, it's very volatile, right? There's ups and downs, and you again, like one thing that I've learned reading the books previously for these past months, as well as watching other inspirational financial advisors, like you don't want to be in the stock market and make decisions based on emotions. That's
Yes.
a big no-no. Meaning, oh man, I'm gonna hear a crash. Okay, I should pull my money out. That's actually the time that you should never pull your money out. Think of it like if there's a big crash and you're able to save your money, that's like a big sale. When you go to a mall and you see us 50% off, 70% off, when there's a big major events happen in the world and with the market crash like Brexit, that's actually the time to buy, because that's when the value of the shares are low and you want to buy low, sell high. And whereas a crash happened, you don't want to take your money out of the market, because they're actually going to, let's say for example, you buy at $1 when the market crash is at 50 cents. So now you're selling for 50 cents, you're losing your money. Versus you stay in there and eventually the market recovers, that's where you gain additional money. So the stocks are not for everyone, and for those that are not financial experts like myself, I'm not a financial advisor. You don't want to gauge on just buying one stock or for one company. There's mutual funds which is a collective of multiple stocks that others have picked out, and you can buy it that way. So the risk is a little bit less when you buy mutual funds compared to individual stock, because individual stocks is based on individual companies, and the companies can go down or up depending on their business and whatnot. So one thing that I've learned as well is start saving retirement early, but also think about there's Roth IRA, there's different form. The Roth IRA, when you take out, is tax-free. The Roth IRA, when you invest, when you take out, is tax-free. There's only limited number of individuals that qualify for the Roth IRA. And like I said, this is one of the things I wish I've known earlier in my 20s, where once you become a pharmacist and your salary or 6-figure, there's a limit on how much you can contribute, and there's actually a limit cap on your salary. If you're a pharmacist and marry another pharmacist or marry another really high earners, you may not even be qualified to contribute to the Roth IRA. Every year, if you're qualified, it's, you can put in $5,500 a year, but if you're not, then you've got to do the traditional IRA, which then when you take it out at retirement, it's going to be taxed, meaning that whatever you take out, it will be subtracted by, let's say you take out $10,000. Well, you're not going to take complete $10,000. You're going to maybe get back $8,000, $7,000, depend on your tax bracket at that point. So that's big. One thing I wish I know earlier, and being able to contribute when I'm a student, even as little as $200, $100, when you're working as a technician or when you're a resident, which I know most folks are like, I'm barely like being able to pay off my rent, right? No, think about Roth IRA. If you cannot contribute or invest in anything, think about Roth IRA, because I think it provides a safety net, and again is a tax-free at the end of your when you pull it out. And there's a lot of companies out there. Again, I'm not going to endorse any particular one, but currently I'm using Vanguard. Vanguard has one of the most number of mutual funds that you can pick from. In terms of stock-wise that you can invest, Robinhood, which
Robinhood, a bunch.
E-Trade, you can
Fidelity,
Charles Schwab. You pick it based on the transaction fee. I have Charles Schwab, and that's what I use, and they charge like $4.95 per transaction of the stock that you buy. And one big thing about stock and investing is invest the money that you're willing to lose.
Yes.
That's really hard to say, but those are kind of fun side money that that you'll be okay with. So that's the biggest thing. Before going there, one thing I would recommend is have an emergency fund. And that emergency fund can sit in like a CDs or in your bank, because you never know.
Yeah, you don't know, stuff happens in life.
Right. So ideally 6 2 months worth of your salary. If anything, your car breaks down, if it flood, hurricane happen, you never know. So before starting with playing in the stock market, I would recommend doing emergency fund at least for 3 months worth of your salary, or 3 months of your salary, and then start thinking about 401k and then retirement. Or you can do it simultaneously.
Yeah.
Have emergency fund on the side, half, and then start thinking about 401k. I definitely agree with Tommy that if the company match at least 2%, 4%, again, different companies have a different matching percentage, but whatever they match, at least contribute.
Put that that's the bare minimum you should put in.
Yeah, because if not, you're basically leaving money on the table.
Yes.
Other thing I want to close with, and then I'll pass the ball over to Tommy again, is when you're looking for a job, you want to think about this as one of the criteria, because again, if you're going to stay at a job for 10 years and they don't have any sort of retirement plan, that may not be good, because you want to have a kind of a buffer point for retirement. So this is one of the things that I would highly recommend people start thinking when you're looking at actual job. I know residency is a little bit different, but definitely when you become a pharmacist. With that, what other thoughts do you have for the audience who are students or even residents or other pharmacists that?
Yeah, like definitely 401k. A lot of companies even offer associate stock purchases as part of their benefits. So looking at the company's benefits when you take a job is a huge part. You don't want to just think about now and what you're getting at your job. You want to think about the future, because you're basically, if you're going to stay at this job forever, you want to get something for it. And so seeing if they have a 401k or if you can buy stocks through them, that makes a huge difference. Oftentimes with the stock purchase, they'll also match that too. They'll match a certain percentage of that. Essentially, that's free money as well. Like I said, you do want to have a safety net first before you get into all of this. Stock market, that's probably one of the later things I would do. 401k first. Get into the stock market once you have some money that you're willing to play around with, willing to lose.
Very good. And then, of course, not everybody has the gut to go and play with the stock market. Bonds are safer, but again, they have a lower return on that end. I would say emergency fund, 401k, Roth IRA, and then individual stock market, because I think that's where the risk is the highest. And one last thing to close is that depends on your company if you're working for or working with. They will have, if they are bigger companies, they tend to have a financial company that they pick, and that's probably what you want to go with them. And then they also provide potentially like free financial service with one-on-one with a financial advisor. I would highly recommend that you guys take the opportunities to do that and meet with them and talk about retirement and whatnot, because it's crazy to think that we're thinking already retirement, like I'm 5 years out of school, but it's important. And
I'm still in school and I'm already thinking about retiring.
And it's important because you don't want to wait until your 50s and 60s and say, oh man, I need to start thinking about this, because again, time is essence and is on your side right now. I hope you find this helpful. If there's any questions or comments or posts, please do it below and I'll make sure I'll respond. If there's any things that you want to connect with me, I am on LinkedIn. I'll also put a link below as well. I hope you find this helpful and subscribe to my channel for other future videos. Thank you.
Thank you.
Bye guys.
Bye.